I think this is like the aftermath of yet another bear market bounce. And these things are mentally debilitating for investors precisely because of how quickly they slip away. Yesterday is the 10th best day of all time for the S&P 500. I heard that breathlessly reported everywhere. I saw the tables, all the graphs, all the charts. What didn't necessarily accompany that commentary was the context in which we've seen the other 9 best days of all time. And I'll spoil it for you. Typically, they take place in years like 1933 and 2008 and 1931, and they happen when the market is in a 75% drawdown, a 48% in October 13th of 2008 was the 6th best day ever. We had a huge 11.6% run. We were already down 35.9% from the high. Yesterday is peculiar in that it didn't take place in a statistical bear market down 20% or worse. It's a little bit shallower than that. But from my perspective, close enough. Horseshoes and hand grenades. The median stock was in its own bear market. Most sectors that matter with market cap were in their own bear market. So what happened yesterday, while it was exhilarating and remarkable and a lot of fun and a lot of backslapping and a lot of rich kids who are really proud of themselves because they grew up insulated from the consequences of their own actions, the end result today is, oh, wait a minute, maybe we put the financial crisis on hold, but we still get to have a recession. So that's how.
Well, I've had a preference for large caps for some time because I felt that small cap equities need more of a cyclical uplift that's sustained and ideally falling interest rates. So definitely stay there. These are going to be bigger, safer companies. I've had a preference for the United States. Obviously, so far this year, that hasn't been working. And I think my preference was largely because I felt the trade war would do even greater economic harm to some of these countries overseas that are being targeted. And I think really it's a matter of how much you're losing in those countries, unfortunately. I guess the main place that I've been pounding the table on is not in the equity market at all, but commodities and particularly gold. I've been bullish on gold for about 1.5 years. And I continue to be. And the main reason driving that view is central banks. We've seen central banks for the last 3 years buying over 1,000 tons a year. And that purchase continues. And it's mainly diversification that these central banks are doing to slowly reduce their reliance on U.S. dollar assets.
Going to be in a recession. And the question really, recession is, a line at zero. You get and then, sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about, let's say 2 quarters of stagnation or a little bit of negative? I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
These gains. Our next guest says yesterday's big rally confirmed the Trump put is back. Tom Lee, Fundstrat Global Advisors co-founder, managing partner, and head of research joins us here at Post 9. Tom, good to see you. So, yeah, we were in search of perhaps some kind of a floor level of a Trump put. Maybe we got there. I guess, first of all, let's go to what history says about these extreme type market conditions, right? We saw very, very rare levels of forced liquidation, washout conditions Friday, Monday, set the scene for the kind of forced buying, panic buying in a sense yesterday. But where does that leave us? Because a lot of those huge one-day rallies have happened in bear markets.
Yeah, I agree. I mean, investors, I think, were fearful we were being pushed into the abyss of a depression. And there's a lot of technical damage that isn't necessarily fixed by just having a one-day rally. So I think that investors are understandably cautious. But one thing that my friend Tom DeMark likes to call is washed out markets. Yep. And I think some things really got washed out, and that's what we're going to keep an eye on. I think it's actually kind of constructive. Like the Teslas and the Mag 7, they basically bottomed on Monday. Yeah. And so even though the markets were plumbing new lows into Wednesday, they were holding up, and they've made a big move. So I think there's an argument to me that high beta and the Mag 7 are what you want to watch. And I'm kind of in the camp that this is going to extend further, the rally.
deficit in the United States. And both of those things might be slightly recessionary. And if that's true, we might have to go through a brief recession in order to rebuild our foundation. And you say, how much longer can investors hold? Look, the market's not up and to the right, every year of every decade. And I think that this is a necessary resetting so that we can grow again in the future and grow more thoughtfully.
It feels like bond investors are coming in because they feel that the Fed is not going to. Like, there's bond vigilante activity potentially happening under the hood here. Does that play into how you think about advising people to own treasuries across the yield curve? Does that play into whether or not it's a safe asset for investors right now?
Yeah, we still think yields are going to move up a little bit, but we still think it's a very safe asset. We're very apprehensive of high yield. High yield spreads are widening, clearly signs of uncertainty. They're still well below long-term averages, but treasuries, again, offer that ballast in the portfolio. Simple example, you go back to 2008. One of the things that only did well, that mitigated against volatility, were treasuries. And with all this said, though, let's say the tariff issue gets settled, let's say, fingers crossed, but let's say it gets settled. The key thing to think about is that treasuries are pretty attractive. We're about 2% over inflation. We have a lot of retail buying of treasuries. We have a lot of foreign investors buying treasuries. Like 27% of treasuries are being bought by foreign investors. There's still significant demand. And if I'm going to get 2% over inflation on treasury yields on a 10-year, it's an opportunity.
And so with that, as I ask you the question, we're only down 3% on the S&P. It's such volatility that it's kept everybody off balance.
It's such a good reminder that big up days are very normal in bear markets, that they're not necessarily healthy. So the big up day that we had yesterday does not mean that we're at the start of a new bull market, because if you go back to those big historic up days, they typically happen in the midst of major bear markets. So we think at the end of the day, vol is here to stay. And if you go back to Strategas, Chris Verone, he put out an interesting stat. 85% of the time, you retest the lows. And so there are certain scenarios like 2018 or 2020 where you had a true V-shaped recovery. But given the fact that this is true policy uncertainty in the hands of one person, we think that you have to get used to this volatility remaining.
Over the place, like what have we lived through in the last 7 days?
Liquidation now, ask questions later. And I think that's the reason why correlations have broken down. But, yesterday the markets hit a bottom and they came back up. And when we look at oil in specific and commodities more generally, the dead cat bounce was really a dead cat bounce. It was relatively small, which I think is telling you a lot, that there's still a lot of risks left in the system. And when we look at the overall tariffs, they're the highest in a century. They're still at 25%. And then second, when we look at who got hit the hardest, it's the superpower of manufacturing. And then the other thing to keep in mind, and this goes to oil and commodities, U.S. is the largest exporter in the world and producer of oil. China is the largest importer of oil. So oil and commodities are in the crosshairs right now. And, when we look at China, I want to emphasize in the United States how they fit together. Yep. The United States is a barbell economy. It's got tech on one end, commodity production on the other. What sits in between? Everything China has. And so when we think about where this trade war currently exists, everybody, viewed as reprieve because everybody else got a 10% and China goes elevated to 125%. China is the critical component here relative to where the U.S. sits. So I think oil probably has this right in repricing the risk again this morning.
Oil's down. Yes. All right. Let's go to Pat in Washington. Pat.
Hey, Jim. Thanks for taking my call out in the Pacific Northwest. I'm thinking of buying a stock called Snowflake. And if not, maybe...
I like Snowflake. I like it. I think that, you know what? When I look at where that stock is now, they're hitting a lot of the tech stocks. That may be a good one to be able to be in right now. God. Yes, it's down a lot. Went down $6 today. I pulled the trigger.